Happy Friday, everybody. Mike Sorrentino here, and it is. I'm almost afraid to say this. All quiet on the Western Front to a certain degree. Not a lot of news to report per se, but I think there are a couple things that are worth kind of discussing and mentioning. A lot of fanfare out there right now on NVIDIA. If you're not sure what NVIDIA is, it's a company that makes chips that go into computers, and those chips are now powering a lot of the artificial intelligence craze that is happening out there. And we're going to talk a little bit about them today. I couldn't help myself. I had to quote from Twitter, or I guess it's called X now, excuse me, from an account there called Investment Hulk, which is kind of like a satirical financial poster, if that's even possible. He posted this, I assume it's a he, posted it this week. NVIDIA is just Taylor Swift for dudes. What that basically is referring to is this love or adoration towards NVIDIA, the company, the stock. It has exploded over the last, call it, decade or so. This is a company that was founded, I think, in 1993. And today, it is the third largest company out there. Apple and Microsoft are the only two ones that are bigger. And it's all because of these little chips that they make. And what's interesting about NVIDIA is that they only make chips for the most part. That's their business. Whereas if you look at like Apple and Microsoft, these are highly diversified technology companies. But this NVIDIA craze has exploded. So NVIDIA reported earnings this week. CNBC, in their infinite wisdom, decided to have a countdown to NVIDIA earnings, like countdown to New Year's Eve, the ball drop. Sometimes I just kind of scratch my head over what's on these networks, but fine. What was interesting though is yesterday, February 22nd, NVIDIA was up, I want to say about 16%. That was the biggest single day market cap addition ever, and by a lot. Now, if that sounds familiar, because the second largest happened just, I think it was like 2-3 weeks ago. It's on here. Facebook or Meta, when they reported their earnings and they issued a new dividend, or a dividend for the first time, their stock went up big. NVIDIA blew them out of the water. $277 billion of market cap value added in one day. I mean, that is bigger than most industries combined. That is bigger than large companies, like big companies, in one day. There was a lot of fanfare around NVIDIA. So the question is this real, or is this a bubble forming? Why are we seeing so much attention around NVIDIA? Yes, it's their stock price, but if you look to see what their quarterly revenue on the left-hand side looks like, it has exploded. They've taken off. This AI craze has brought in a tremendous amount of business and opportunity for the company. And that is translated on the right-hand side, the revenue, into quarterly net profit. Their profits are jaw-dropping, and they are expected to continue to rise. So it's hard to predict the future, and it's hard to determine whether these forecasts are going to be correct or not. But if you ask yourself, why is the stock going up? It's because of these numbers, because of the sales and profit expectations going forward. NVIDIA could be one of the most historic stories, whatever you want to call it, in corporate history by the time we're done with this in a few years. So it's hard to say. I don't know exactly what's going to happen, but this is the reason why NVIDIA is so top of mind. Now, I get a question all the time. Do I own NVIDIA? Is it in my portfolio? Most of the time, if you own stocks, particularly here, the answer is yes. Now, sometimes we might own them directly, sometimes we might not. But if you look inside a lot of the major or the large ETFs, okay, particularly like S&P 500 ETFs or technology ETFs, which we tend to favor from time to time, or the Qs, which is the NASDAQ 100, you're going to find NVIDIA in there. Okay, so yes, a lot of our strategies have exposure to NVIDIA. Yes, a lot of our strategies are exposed to artificial intelligence. The way we try to play the AI call revolution is not necessarily try to pick the winners and losers, okay? What we're trying to do is we're trying to ride the wave of AI, not necessarily to try to determine who's going to win and who's going to lose. That game is a very risky and dangerous one, and we just want to have exposure relative to having to pick the right ones along the way. But I think what's the bigger picture here, what's going on this year, I think we started the year in our state of the markets, and one of the things I mentioned was I never in my career have seen uncertainty this high. We don't really know what's going to happen next, and I think there's a natural reaction just because we're human beings. There's a natural reaction when we hear uncertainty to assume that means danger. And I was very clear to say at the time, don't try to equate these two together. Uncertainty and danger are two very, very different things. Uncertainty could mean tremendous opportunity going forward, and we firmly believe that over the long run. Okay, I think the uncertainty is more along the lines over the next 12 months, maybe 18 months. But if you look past that, there's just so much tremendous opportunity. It's not just AI. We talk about a lot of how the consumer how consumer spending is changing, how healthcare is being revolutionized. Things like CAR T technology being expanded in now into actual tumors, are eating the cancer away in people's body. All these different things that are going on right now are exciting. But this uncertainty near term was something that we addressed. And I said very clearly, I don't know which way it's going to go because nobody does. But what we're starting to see now is optimism is rising. Now, that doesn't mean that we're out of the woods. It doesn't mean that the recession risk is off the table, okay? Because look, people are still losing their jobs. Spending is better, I think, than we expected, but it is absolutely being impacted by things like inflation and wages and things of that nature. But for all intents and purposes, optimism does appear to be rising. This is a good example here. Now, again, this is very near term, but if you compare January to February in Bloomberg's Economic Outlook survey, those blue bars have expanded across the board. Now, if you look at GDP in general, the original expectation for 2024 was 1.5% in January. That's now been moved to 2.1%. To be clear, that is net of inflation. That means that after you incorporate the effect of inflation, we're expecting 2.1% economic growth now. That's great. That's pretty good growth for an economy the size of the US. I think what really matters, though, is looking at consumer spending more than anything else, because that drives our economy. That's 70% of our economy right there. And as you can see, that second row of bars there, 1.5 has now been moved to 1.9. So that's great to see. Government expenditures, that's not so great to see because when they spend money, it tends to not be spent all that efficiently. But my point here is that optimism does seem to be going up. And it's not just here in the US. If you've been following what's been going on in Japan for the last 34 years, Japan has been in a just brutal economy. Now, people aren't starving there and sleeping on the streets, nothing like that at all. If you go to Tokyo, which I was there maybe 4 or 5 years ago, well, maybe a little bit longer than 5 or 6 years ago, you wouldn't have felt the fact that that country has been in an economic downturn for over 3 decades. What's been interesting over the past I'd say maybe about a year now, is that they've got two main indexes there. One's called the Nikkei, and basically this index reached out to, I'm sorry, take a step back. I'm sorry, the stock exchange over in Japan, excuse me, the stock exchange rather, issued an ultimatum effectively to companies over there a couple months ago, basically saying, look, get your valuations of your company above a certain level, and if you don't, we will delist your company from the stock exchange. Now, what did that do? That was a game changer for Japan. Japan's problems were all self-inflicted for the most part. They had a property bubble in the 80s that's well documented, but their biggest problem, frankly, it comes down to their labor laws. They don't really let outsiders in very often, and when you get a job there, it is virtually impossible to be laid off or fired. Okay, so and that might sound good from a protectionist standpoint, but the problem with that is that it has destroyed innovation, it has destroyed capitalism in a way where their economy has not been able to get by. And the amount of debt and spending that government has done over the last 3 decades has just been a real problem. So basically what is happening now, companies finally have an incentive or motivation rather, to fix these problems. Because if they don't, they get delisted. If they get delisted, all these managers and CEOs and all these executives over there are going to lose a lot of money. So now their feet have been put to the fire, and they are working and fixing their businesses to get their valuations up. And it is so far has been working. And as of this week, as of yesterday, I believe, finally, after 34 years, Japan's stock market is back at an all-time high. So it will show you that, and what's going on here, like I said, has to do a lot with these reforms that I've just discussed to a degree. But there's also a little bit of this tech wave that's hitting Japan too. Okay, so this AI craze, whatever you want to call it, is kind of infecting, or it's good contagion. It's affecting so many different industries as well. There were stocks that reported earnings over here in the US this week that were down because their quarterly earnings were okay or not great. They didn't meet expectations. They were just down 4 or 5% in some instances. And then NVIDIA reports yesterday, and it actually reversed the downturn of companies that are associated to AI in some way. Because NVIDIA's earnings were so good, it reversed the negativity that was priced in some of these other stocks. We're talking about some crazy things that are going on right now. And a lot of people are using this corollary to 1999. And my argument against that is, well, yeah, but the problem is in 1999, nobody was making any money. These companies had no sales, let alone profits. What's going on in AI right now is these companies are making, well, not all of them, the kind of the cream of the crop are making a ton of money, and it's going to only go higher. So it is kind of an exciting time from that perspective. But like I said, when we think about the long-term opportunity for investors, it is so much more than just AI. So let's shift gears. I wrote this week about a very controversial subject. During presidential election years, what I like to do is like to drip along throughout the year data to support the fact that elections at the end of the day don't have as much meaning and impact as most investors might realize. Okay, and I'm not trying to change somebody's religion or political views or whatever you want to call it. This is purely just a way to try to slowly strip out the heated emotions that people feel around elections. And let's be honest, most of us do, all right, myself included. All right. So what we have to do, though, as best as possible, is to eliminate as much emotion from the investment process as possible. Because if we don't, that's the real risk here. The risk isn't that the Democrats win or that the Republicans win. The risk is we get emotional about the results and let that emotion impact our investments. So what I did this week was start this conversation by asking a simple question. Who's better for the stock market? Is it going to be a Republican win? It sounds like Trump is going to be the Republican candidate. All right, or is it going to be Biden or whoever Biden's replaced with? We don't really know what's going to happen in the Democratic Party just yet. Okay, and I don't know. Right, so let's look at the data, because what I find interesting, and this is the same thing at every presidential election cycle, is both parties, Democrats and Republicans, use the exact same historical data to support why their candidate is better for the stock market. I see this every single election year, and I just sit there and I scratch my head. I'm like, why do they keep doing this? Well, I know why they do it, but it's a little frustrating, because the thing about data is you can massage data any way you want. You can force it to tell you to support any conclusion that you want out there. So I'll give you an example. Go back to 1928, and on the left-hand side, the presidential election results. When a Republican was elected, the year that a Republican was elected, the average return was 15.3%. And when a Democrat was elected, the average was 8.5%. So if you think about it from a Republican standpoint, you could say, hey, look, you know, if our team wins, historically speaking, the stock market has done better that year. And the Democrats could say, well, hold on here. That doesn't make any sense. Like, why would something that happens in the last few weeks of the year drive results for the entire year? You don't know who's going to win the election until November. All right. And furthermore, it's not like that person has even been sworn into office. That doesn't happen until January of the following year. And if you look at the following year, the actual year that they're in office, the Democrats could say, well, you know, that the first year of a presidency, when a Democrat's in the office, you know, the market's up 20%, whereas a Republican, it's only 12%. So we're better. And a Republican could say, hey, wait, hold on here. You're comparing apples to oranges. We went back to 1928 on the left-hand side, and on the right-hand side, you're starting in 1977. Those are very different data sets. What's going on? And my point here is that this could go on and on and on. You could slice and dice data a million different ways to do whatever you want, okay? Be very careful about these types of data sets because you're going to start seeing a ton of them going forward. The closer we get to the election, the more you're going to see. And honestly, most likely, particularly in the media, most of the data sets are going to be correct, okay? It's really hard to screw up data like this. All right, I'm not saying they're faking the data. I'm just saying they're massaging it to support a conclusion. They're putting the cart before the horse. They've got a conclusion, and they go back and they play with the data until it supports whatever conclusion they're trying to achieve. I want you to focus on something completely different. I want you to focus on this chart. This is the way you invest in an election year. And guess what? It's not much different. In fact, it's almost no different than any other year. That red line at the bottom, that is if you invested in stocks only in years when Republicans were in the White House, okay? The blue line is if you invested only in the years when Democrats are in the White House. The black line is the interesting one. That's if you remain fully invested, irrespective of who's in the White House. It's not even close. So, like I said, we're going to talk more and more about this over the coming months. I want us to keep an open mind. I know we can get heated and we can get political very fast, but this is our nest egg. This is our future that we're talking about and our retirement. All right? We got to take the emotion out of the equation. With that, have a great weekend.